Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, 2026 is already off to an interesting start. I was on vacation for the holidays, lost track of time, didn't know what day of the week it was, and then I woke up to the Venezuela news and was like, I guess I have to work on Saturday now. It was eventful.
Yeah, absolutely. I think most people were shocked by it. But yeah, the news flow is ridiculous. It's like a year of news in a week, every week. But in fact, the Venezuela thing already seems a little distant past, but it is a major deal. And we were struggling to get somebody on ETF IQ, the TV show I do. We wanted to talk about this. So I did an F search, which is the search through ETFs. And I said, okay,
on the terminal,
which ETFs hold at least 1% of Venezuela? And only 4 results, and they're all bond funds. And the only one that had the highest and was active was VEMY, right? And that's the ETF.
VEMY.
VEMY. And this is an active manager. I hadn't heard of them. I know Virtus, it was a white label, but Stone Harbor was the name of the manager. I basically reached out to my buddy Seth over at Virtus. He hooked us up with Jim, who is on the show today. And we had a great discussion. He came in at last minute and talked about the bonds and why he owned them. And he bought them a year ago. So he saw something pretty early, and I think that's interesting. Then I looked through the portfolio, and it's like doing really well. And there's some of these like really interesting countries that are like really killing it, like Latin America countries, but also outside of that. So I thought we should really get into this like EM debt situation, because we could see other situations, right, where some really left for dead bonds get restructured, and like how can you benefit from that?
Can't wait to continue this conversation. The Jim that you mentioned, Jim Craig, who is the CIO and head of emerging markets and co-founder at Stone Harbor, the ETF that we're going to be talking about, Virtus Stone Harbor Emerging Markets High Yield Bond ETF. Again, that ticker, VEMY. Also joining us, Damian Sassower, fixed income analyst with Bloomberg Intelligence. This time on Trillions, around the world with emerging markets debt. Jim, Damian, welcome to Trillions.
Thank you.
Thanks for having me.
Okay, Jim, what did it feel like when you woke up? I was on vacation, woke up on that Saturday to the U.S. basically going into Venezuela and extracting its president, Maduro, as well as his wife. What did it feel like to wake up that morning for you?
It felt pretty good. We were anticipating something would be happening in short order. You never know the timing. Didn't know exactly what was going to happen, but that was certainly a pleasant surprise. We've been witnessing the kind of collapse of Venezuela for a long time. So this is a positive change in our view.
When were you able to actually get exposure to the country? Because, there's sanctions. It's very difficult to be thinking about this. If you're an oil company, the only one that has a meaningful presence there is Chevron. They have a special waiver. So what makes emerging market debt different?
So this is a country that defaulted and was restructured in the early 1990s. In fact, I was part of that team. So the debt has been outstanding in trading for quite a while. More recently, the sanctions were removed from trading the debt, and that was several years ago, and we've been accumulating that debt since then.
How do you go about doing that?
So it trades pretty actively. So it's one of the more actively traded entities in the emerging markets debt market. It trades over the counter. It's all denominated in dollars. Has coupons and maturities. Obviously, they're in default, so you're able to pick from a menu of options.
Okay. Quick question on the bonds. So you bought them a year ago. I believe they're up like 140% in a year. Now, they went up like 100% before the extraction. Then they get another boost after the extraction. Was the run-up in return because people thought an extraction was going to happen, almost the way like animals can tell a tsunami's coming before humans? Or would you have a restructuring even if there wasn't an extraction? Or was this whole thing a bet on something happening with this guy?
It's really the claim value of what you're getting when you buy defaulted debt. So if you think about Venezuela, they've been in default since 2017. So your claim value was par, 100 cents on the dollar, plus past due interest, which is about another 50 cents or so. So let's say 150 to 200 points in claim value. And the dollar price was somewhere around 20. So you're buying something at 20. The claim value is very high. What is difficult part is figuring out the timing of it. So last year, the timing was getting closer to whatever that means. We didn't know there was going to be an extraction of Maduro, but there's going to be some sort of change, and that was closer. And as that closeness becomes more of a reality, the bond prices went up.
How do you go about figuring out what percentage of the portfolio you should expose to something that could be, kind of a gamble?
We do a lot of probability analysis in everything that we do. So we put probabilities around what's the upside, what's the potential downside, and we weigh it based off of that. And we do this every month for everything in our portfolios. The probability that Venezuela was going to have a regime change of some sort had increased. So that increased our weighting in Venezuela. And that's something that we feel very strongly about. I mean, you have to factor in the downside as well. And we're not out of the woods yet, but that downside, I think, is lower now than before. So that warrants a larger weight.
Okay, so the name of the ETF has emerging markets in it. Is Venezuela actually an emerging market, or is it more like a frontier market?
It's more of a frontier market right now, but it used to be just an emerging market. So it's hopefully coming back and adjust to the emerging market category.
And I mean, there's that line is obviously like where there are countries that are uninvestable almost, and obviously Venezuela's entered into the realm of being investable. But how do you think about the risk reward for these profiles? Because a lot of the countries that are in the portfolio, Lebanon being another one, like these are countries that are, the reward could be 10 years off, really. So how do you go about figuring out what's real and what is just too risky?
That's a great point, because the reward could be 10 years off or 5 years off or 2 years off, and that time value of money is very, very significant. About half of the emerging markets,
then you wake up one morning and look like a genius.
And you look like a rock star, but about half of the market itself is actually investment grade. So lots changed over the past 34 years I've been doing this. And the other half is non-investment grade, and within that there are different tiers of non-investment gradeness, put it that way. And Venezuela, Lebanon are at the lower end of that.
Yeah.
And those are the ones where those can be kind of your deal drivers if you think about it from a financial terms. Those are the ones that could have, if you have a good information edge, you could do really well in.
What can't you invest in?
Right now, things like Cuba, although Syria may come on board at some point. There's North Korea. These are countries which you really can't invest in.
The ones when you do the compliance training at your job, it's like, do not do anything that involves these countries.
Yeah. Russia's in that right now.
Yeah.
So these are countries where you get put in the bad house if you invest in those for obvious reasons.
But do you have to keep up on them? Because at some point, like maybe Russia comes back online and that becomes an opportunity, right? You can't be completely in the dark about them.
100%. We have an entire team just going through the OFAC, Office of Foreign Asset Control website to see what new updates there are. Has a country been put on or taken off? That's very important. And obviously maybe it's not obvious, but to me, you want to be ahead of that. So if a country comes off of that sanctions list.
As Venezuela sounds like it did.
It did.
You were there.
You're exactly. The Venezuelan bonds at one point traded at 2. So now they're trading at 35. So you want to kind of front run that flow if you can.
Be there when it's 2.
Right.
Let me bring Damian in because he's a mile deep in this stuff. I always overhear him talking about this. You're writing about this all the time. Were you into Venezuela a year ago? Let's just start with that country for you. How's your research been on Venezuela before and after the extraction?
Well, I think we have to look back at the fact that these bonds were sanctioned. You weren't allowed to own them, right? Until former President Biden basically removed the sanctions on trading in the secondary market, which opened the door for Jim and for others to start buying up these bonds again, right? So that's relatively recent. And if you look at like the return, I mean, you're absolutely right. I mean, if you look at the JP Morgan MB Venezuela bond index, rose 100% last year, but it's not alone. Lebanon, Ukraine, Sri Lanka, Ghana, all of these sort of Zambia, these distressed EM dollar bond issuers have had tremendous years in 2025. So you have to kind of parse out how much of the move is due to people, expecting regime change in Venezuela, and how much was just the beta trade that we saw in EM high yield over the better part of last year. My goodness, it's been a good run.
And what's underlying that that beta trade? Like why the enthusiasm for countries that we haven't really been hearing that much about?
I would say risk sentiment, suppression of volatility, the VIX, all the things that we look at, right? I mean, vol is at cyclical lows across equities, bonds, and FX, right? So, I mean, that's a perfect environment for investors to go and, extract carry, right? And look, Venezuela doesn't pay off, right? I mean, these are defaulted bonds. There's no coupon income there. But, the point is to take a little bit of a punt on, a very binary outcome makes a lot of sense when the bonds are trading at, 5 cents on the dollar, right? And the rest of the universe in EM distressed is up in double digits plus. So, kudos to Jim and the team at Stone Harbor for identifying that and, identifying the fact that the bonds were no longer sanctioned and that they do demand a place in investor portfolios, albeit probably a very small weighting, relative to other more developed markets.
Well, that's a really good point, Jim. Like you wouldn't be able to get this exposure through any other ETF, right? Like, so how do you talk to institutional investors about how to put this into a portfolio when, what you're offering here is not something that anybody else is going to get through, like, bond?
Well, it's interesting because most of our client base is actually institutional investors, and they want that exposure. So they view the market very differently than a lot of others. They view this as a market that has historically outperformed other fixed income, comes with higher volatility. They appreciate that, they understand it, but that volatility can be a friend as well. So they want that exposure, and something like a Venezuela is something they understand from a risk and reward standpoint, and they want to be exposed to that. But to your point, on the ETFs, there aren't that many ETFs that actually own it.
This is where I think ETFs are perfect, because this makes something very complicated and almost impossible for most people very easy. You just, roll out of bed and you click buy and you own all these cool bonds, right, from these frontier countries. The diversification
emerging market countries, some of which happen to be frontier.
Well, I'm looking at the portfolio. I mean, honestly, Kazakhstan, Ethiopia.
Yeah, but Kazakhstan's a pretty good credit. I mean, you got to take a step back here. I mean, because now you're getting into the long weeds with me. Venezuela is a very unique situation, right? I mean, you call it frontier. I mean, it used to be one of the most developed of emerging markets going back to the 70s and 80s, right?
It was.
Until things happened.
But Bolivar's figured prominently in a James Bond movie. I learned through all of this. Yeah.
Caracas. But look, I mean, I think you have to kind of take a step back and say, okay, it's not just ETFs, guys, and I know this is trillions here, but active fund managers, I'm hard pressed. I did a whole research report last week. I was looking for anybody who had VEMY on their books, and outside of a few funds run by Ashmore, one by GMO, very few funds have greater than 3% of their portfolio in Venezuela, and that's after last year's 100% plus gain. So, it seems like investors have been very, very I don't want to say conservative, but they've been managing that concentration risk really, really well, because we're not just talking about VEMY sovereign bonds. We're talking about PDVSA, the state-owned oil company. Again, these are all dollar-denominated bonds, but those are the two big issuers. There's other little Elicar, the utility. There's some other, sort of VEMY-linked debt out there. But, by and large, what we're talking about is PDVSA and the Venezuela sovereign, and those bonds, $70 billion outstanding. Just how much of that can you own in a portfolio to give you, I don't know, double-digit exposure? I mean, it's going to be a challenge.
Yeah. Well, let me bring real quick here. We don't separate. There's EM debt. There's investment grade, which would be the big ticker is EMB. Then there's high yield, which is the big ticker is EMHY. Those are the two big iShares products. You're high yield, so you're basically trying to beat EMHY. Now, let me go back to Damian on this. Like, let's say you're, your college roommate texts you and says, "Hey, I saw this Venezuela." This happens to me sometimes, and he's like, "I kind of want to get in on this stuff." Do you tell them, "Hey, look, maybe don't do high yield, do more of the investment grade," or should you have both? Like, what's the normal person's play here in terms of like adding this to a portfolio, and the difference between going high yield or investment grade?
So I guess for me, look, most people link emerging market debt, forget about investment grade or high yield within EM, they assume it's high yield.
Yeah,
right?
that's what I'm
I
saying.
mean, that's the historical
It's assumption, yeah.
You know, we were always the guys, we EM, portfolio managers and traders, we were always the guys, they plunk us at the end of the row, right next to the US high yield guys. We were like the stepchild, right? The one nobody wanted. And obviously as the asset class has developed over the better part of the last 25, 30 years, things have changed. But, far be it for me to judge, what makes, investors kind of, look at emerging markets, in my opinion, it's going to be about carry. It's going to be about, higher coupons. It's going to be about, and you're paid for that risk, right?
Hold on real quick. Just for anyone who just was like, what does that mean? What is just describe carry.
A return over and above U.S. Treasuries, in my mind. If you're talking about U.S. dollar debt, if you're talking about dollar-denominated paper, you're benchmarked to the U.S. Treasury curve, right? So how much excess return, excess yield are you getting by investing in emerging market dollar debt, all else equal, maturity, duration equal, relative to U.S. Treasuries? And you get considerable, there's very few asset classes, U.S. dollar-denominated fixed income asset classes that can give you that additional, that incremental carry, that incremental coupon.
Yeah, so Joel, I'll give you the numbers. The GOVT, which is the iShares government bond ETF that covers the whole curve, is up 7% in the past 2 years. VEMY is up 31%, EMHY up 27%, and EMB up 21%. So that's the carry, right? So it has worked out for sure, and high yield's done even a little better.
Yeah.
Fair to say?
Yeah,
okay.
Absolutely. And look, again, what we're kind of, when you look at, emerging market debt, most people, it's mostly sovereign, quasi-sovereign issuers, but in this instance, there's we're talking about both, right? We're talking about PDVSA, which is a state-owned oil company, i.e. a quasi-sovereign issuer, and you're talking about Venezuela, the sovereign, right? So when you look at EMB, it's all sovereign, it's all quasi-sovereign, but they avoid all EM corporate stuff, right? So if you want to kind of expand the universe into EM corporates and start looking at the Pemexes and the Petrobras, well, Pemex is a quasi, but Vale is another one. Carry, incremental coupon, return potential goes up that much more. So it's really about how you carve up your universe. And, from I guess, Jim's perspective, did a pretty good job of identifying what was really one of those last few vestiges of, incremental upside in EM, because as far as the eye could see, there were very few with the potential to do a triple-digit return, year-over-year return like VEMY did.
It's been a good year. There's been not a lot of those opportunities out there. There's still a few out there that are right now, but no, to your point, you have to identify them. That's the benefit of tooting our own horn here from an active management standpoint. But I think it's important to note an actively managed ETF in this format, I think, really does work well in the strategy, because you can overweight those opportunities.
Yeah.
Actually, on the question of sovereign versus corporate, and you brought up PDVSA there, like, Jim, what exposure do you have? Is it all sovereign, and is there any desire to try and go get the PDVSA debt?
No, we definitely own PDVSA debt. In fact, we're more overweight
in the product, in the ETF.
Exactly.
Okay.
So overall, we're about 55% sovereign, 45 corporate. So we do.
Is that by design?
By
Have that
design.
mix?
So it's roughly 50-50 by design, but we're overweight sovereigns right now. But to your point, the corporate market has grown substantially in size and volume, and it's very liquid. And these are name brand companies that are world renowned, and they do quite well, and they actually offer a lot of extra yield. So why not take it?
Well, Jim, can I ask you, how much of your position is in those 8.5% PDVSA 2020s? Because you guys should be aware, not all bonds are created equal. And this particular bond is secured by 50.1% of Citgo. Citgo here in the U.S., Venezuela, the three big, huge refineries here in the U.S., as well as convenience and gas stations across the country. There has been quite a bit of movement there. I'll let Jim go into it a little bit about Paul Singer and the folks at Elliott and some of the recovery that's already been priced into that particular issue.
Right, and that bond never really sold off as much as the rest of the Venezuelan PDVSA debt, and it's now trading at par. So the claim value is obviously very, very real in that, and that's working its way through the court system. We don't own that. We preferred to put the risk in lower dollar price bonds and try to maximize more of the upside. But I'm very happy that that's working its way through. I'm happy for the bondholders that they'll get some recovery value there, and I think that's appropriate.
Let me ask you about Latin America, because 28% of the fund is in Latin America. A couple of weeks ago, we did our 26 ETFs to watch in 26. Joel knows I picked OTGL, which is a LATAM ETF. I saw the news in Chile about their new leader there. Just saw what happened in Argentina. that stock market was like on fire. And I know from covering ETFs for 20 years, if there's ever like even a little hope that a pro-business leader takes over for a socialist, the market goes wild, right? I always thought it's a geopolitical sports book is these single country EM ETFs. You have a lot of these in here, and like Ecuador was a big winner. In Latin America, how big is this story of political change there?
It is big because we are shifting more towards the right, and we had shifted more towards the left. A lot of reasons why, but the shift towards the right is very important. If you look at a country like Argentina, 10% yields, you've had a big transformation there. You've had a pro-market government that came in and put some very significant fiscal discipline, great team. Obviously engaged with the U.S. Treasury, which has been well publicized, and all of that is transformative from a country standpoint. So if you look down the road, you're going to see a lot of foreign direct investment going in Argentina, debt to GDP coming down, inflation coming down, et cetera, which is, we want to be part of that story.
And how do you decide that 28% is the right number?
Yeah, there's a lot of opportunities around the world. You mentioned Lebanon and Ukraine, and there's a lot of sub-Saharan Africa. So it's a nice buyer's market out there. So the 28% in Latin America, we don't have a huge weight in Mexican sovereign right now. We don't have a huge weight in Chile. A lot of things going very, very well. The yields aren't high enough for us at this point, but we do like Venezuela, and we like Argentina, we like Ecuador, we like countries such as that, and that and get you from the bottom up to your desired weight. But there's other opportunities around the globe which are equally as fascinating.
Well, I mean, let me just expand a little bit on that pro-right pivot across the whole of Latin America you're referring to. We have a number of elections coming up this year, right? We've already seen Chile. That's the pro-right pivot. And by pro-right, we mean more business-friendly, more of a pro-U.S. pivot. We've got Peru coming up, and we've got, quite frankly, Colombia coming up, in May. And we all know what's going on there. And the fact is the Colombia president, Gustavo Petro, can't sit for another term, right? So there will be change. So by and large, the next person sitting in that seat will undoubtedly be more pro-U.S. than the current administration. And then you've got Brazil at the end of the year. Now, don't get me wrong. Lula has 9 lives. We all know this. But, this pro-right pivot that's going on across the whole of Latin America is real, and it makes sense. And it's good for business, and it's good for the bond prices. And that's the way the market tends to be trading here. One thing about Venezuela, if you want to kind of read through into what this means for financial markets and for investors, and again, Latin America speaks to this loud and clear, commodities, not just oil, but minerals and metals as well, right? And, if you just look at, Venezuela, it's a top 3 holder of in-ground gold. If you look at, gas, it's the 7th largest holder of gas reserves in the world. It's obviously got the largest proven reserves of oil in the world. If you think about this, if the U.S. actually does have some modicum of say over, energy supply or oil supply coming out of Venezuela, you take Guyana, you take Venezuela, and you take the U.S., and you add it all together, the U.S. is going to have, I guess, a say over 30% of the world's oil reserves. That's a massive geopolitical shift, considering Saudi Arabia controls only, 12 to 14%. So this is kind of striking, and this is pretty big news.
All right, Jim, we've covered Latin America, Venezuela. Now, your portfolio, again, I look at it and it's like a trip around the globe. There's a country here I've never even heard of. And I feel like I'm pretty smart. But anyway, I'm going to yell at a country, or I'll say it. I won't yell it, but I'll say a country, lightning round. You guys give me real quick, like your 1 sentence or 2 sentence take on this country in terms of your, optimism or pessimism, okay?
Jim also has to say if he's been there.
Yeah, okay.
Okay, great.
Okay. All right. Well, Dominican Republic.
Been there. So a shift to the right, similar to our prior conversation, a lot of yield. Tourism is up. That's a significant part, been upgraded. The spread should continue to tighten.
You got to let me talk about Dominican Republic. It has been one of my favorite calls over the better part of the last, not only year, 2 years. And I'm not just talking the dollar-denominated debt. They have local currency, DOP-denominated debt as well. This is a country that is still running a current account deficit with the U.S., so it's not on Trump's radar. Yet it is the fastest growing economy in, Latin America writ large. I've been there a couple of times myself. They have some good golf courses. And look, the reality is Dominican Republic is its credit rating, its credit profile is improving. It's friendly to U.S. business. And so, yeah, I mean, I'm very bullish on Dominican Republic.
Okay. Sri Lanka.
Have not been there. extremely important in geopolitical sense. So if you think about where it is in the globe, there's a big ocean right around it. So it's very, very important. China's made some huge inroads there. We think that that's changing. We went through a restructuring last year. We like the restructured debt a great deal. We do think there's been a fairly significant political transformation as well. But I think the big important point here is how strategically important Sri Lanka is in the world. And I think the U.S. understands that and appreciates it. So I would expect that that's going to be a big focal point for the U.S. going forward.
Yeah, I've not been to Sri Lanka either, but I will say when you think Sri Lanka from an EM investor standpoint, you think China. And by the way, this just dials right back to Venezuela. I mean, did you know that loan commitments by country coming out of the China Development Bank, Venezuela is the sixth largest country that has received loans from China, right? So let's think about, a workout scenario for these VEMY and PDVSA bondholders, right? There's a lot of bilateral loans to China and Russia that need to get paid off as well. And where do you sit within the capital stack, right? Who's priority? Who's subordinated? These are questions that are going to take a while to kind of come through. This is going to be a very complicated restructuring in Venezuela. But when I think of Sri Lanka, I think of the port that's been funded by China. I think of, its ties to China, and whether or not those continue or not is going to be, really front and center in the eyes of U.S. dollar investors.
All right, this Ivory Coast. I couldn't even tell you where. I know it's in Africa, but I couldn't point it out on a map. What's going on there?
High growth, recently upgraded. Cocoa prices are high. It is really a poster child for what to do right in sub-Saharan Africa. We expect that is a country that's going to continue to see a lot of foreign direct investment going in. I mean, its major export is cocoa, so we like to see high cocoa prices there. But they've really gotten a handle on the finances, and it's been reflected in the fact that they've been upgraded and spreads and yields are much lower. So it's one of the countries we've actually started to take off a little bit. It's done so well.
Yeah, well, I think one thing you have to point out, even though these are dollar-denominated bonds from Cote d'Ivoire, it's part of ECOWAS. So effectively, the currency that's used domestically on the ground in Cote d'Ivoire is the euro, right? It's a former French colony, and that whole region, there's probably 7 or 8 of them from Benin to Burkina Faso, Senegal. They're all, euro denominated. So, their balance sheets and their sort of trade deficits are a little bit easier to read, so to speak. But yes, Cote d'Ivoire has had a wonderful run, unlike its partners Senegal. But the risk there is a lot of the risk we're seeing in places like Nigeria. It is very, very close to the Sahel region, where there's a lot of terrorism, there's a lot of ISIS, there's a lot of potential for things to kind of derail the success story there. But no, it's managed really, really well, and it's had some considerable upside. Yeah.
All right, another country I was actually in about 14 months ago, Vietnam. My wife is of Vietnamese descent, so we went there. We go once every 12 years. And look, this is a hardworking group of people. But I don't sense a lot of innovation. It's a lot of selling stuff out of the front of your house kind of economy, but very hardworking. Nobody's like slacking off. There are no people just hanging around, really. It's very busy. But what's the deal there? What's the trade there? Is that also opening up, or is it just more, that they're taking a lot of the manufacturing from China?
They're taking a lot of the manufacturing from China. That's pretty well known. And it's also known by the Trump administration as well. So if you think of the tariffs that were put in place, and really outside of China, Brazil to a certain extent, Vietnam, and maybe a handful of others, really didn't affect our market. But Vietnam is one that does stand out to us as being more vulnerable. So that's one that we've taken down more recently. Economy's doing very well. It's a hardworking society. It's a fantastic long-term investment, but probably more from an equity standpoint than a debt standpoint.
So there's a moment in which you start to pare back because you're just like, we've done this already, and it's had its upside, and now we have to kind of lower it. So when you go from 2 to 4% in Venezuela, you go from 4 to 2 in Vietnam.
Right, and that happens a lot in our markets. Things get ahead of themselves, and the euphoria comes in. And I think in a country like Vietnam, I understand why. You don't get a lot of upside out of that.
And how active do you have to be as an active manager in a portfolio like this? How often do you have to be recalibrating these numbers?
I wish more often. These things take a while to play out, so it's usually our holding period can only be anywhere from a week to a year and a half on average. So they take a while to play out. We'd love to see them play out a little faster sometimes, but but more often than not, they just take a while to play out. And Vietnam's a classic point. So that trades well under 200 now in spread and extra yield. So that doesn't offer a lot of value for us.
Jim, how much Vietnam is there outstanding right now? I mean, I've always struggled to find any dollar pay Vietnamese bonds.
There's one.
Right. There's one, right? I mean, there's really
right.
not a lot.
There's not a lot out there.
Hence your point that it's an equity play, right? I mean, if you want to get your Vietnam exposure, it's easy to do it via the equity market.
I would do it in equity market, right?
Okay, actually, there's like 2 countries in here I've never heard of, and then a third one that I faintly think I might have heard of, but I don't even know. Okay, don't make fun of me. I'm just being honest here. Okay, I'm just going to spell it. I mean, I'll try to say
Suriname.
That's it. Suriname. What is that?
Great little country.
Where?
Also defaulted its debt. Latin America also defaulted on its debt and has been restructured it.
How'd you know I was going to say that?
I know everything, Eric.
That's pretty good, dude.
I've been doing this far too long. So yeah, I mean, Suriname is northeast Latin America. Not far from Guyana, where ExxonMobil has some offshore drilling rigs in place there, and some of the spillover people would kind of argue for is some of the oil wealth that's being generated offshore outside of Guyana can kind of filter over into Suriname, but they've had their issues. They defaulted, as you know, and it is a country. I mean, what's its biggest export? I mean,
oil.
It is oil, right? Yeah. So go figure, right? I mean, what do I know? But I think, the bonds are they've come back quite a bit, but there's probably some upside there if you listen to people who are far smarter than I.
Joel, had you heard of that country?
No.
Okay, thank you for being honest.
Good one.
And one more I never heard. I'll spell it. See if you can guess it, Damian.
Kyrgyzstan?
No, I have heard of that. Okay. Barely though. Gabon? Gabon?
Gabon's easy. Gabon's an old story.
Right?
I'll let my colleague Jim talk all about it.
Because I didn't look that bad last time, but where's this country?
Africa as well. So it's a interesting little oil trade if you think about think about how to frame it. So it suffers from oil volatility. It's a small country. We happen to like it right now because its oil prices here are favorable to it. But it's I would say on the spectrum of being dicey, non-dicey, it's one of the dicier credits. So we're pretty nimble in Gabon, but right now it's pretty attractive.
How important is it to visit any of these countries?
I'd say it's very important. I have not been to Gabon. I will say that. I've been to most of the other countries in our market, but it's very important. You know what you do? You meet with government officials. You try to meet with the Secretary of Finance, the economy ministers. You meet with a lot of the embassies. Great intel there. I mean, it helps you paint a picture. So you can have all the great assumptions in the world, but when you get there, you really do figure out if they're right or if they're wrong. And that's what's helpful. So we typically visit 35, 40 countries a year.
Jim, if we put on that optimistic hat here for Venezuela as we wrap, restructuring of the debt is something that seems like it's going to be out there. As we look ahead to what's next for Venezuela with that optimism hat on, what would that restructuring look like and how would it impact how you view investing there?
So we would take our defaulted bonds in dollars and we'd sit across the table from Venezuelans, or probably the IMF would be involved, I'm assuming the U.S. Treasury, other investors, et cetera. And you hammer out a restructuring which allows them to grow. So the debt payments have to be lower. Probably the stock of debt needs to be lower as well. And it's something that gives us the ability to get paid back. So that restructuring is very similar to I would expect to the restructurings that we dealt with in the early 1990s, where you're exchanging your defaulted debt for new debt. There also may be what we call a new money component, which means you may want to put in more money. There could be an element there. There could be a value recovery right or some sort of warrant that's given to you. GDP warrant or an oil warrant like the old Venezuelan bonds that give you some upside if that does work, if the plan does work. But ultimately what you're going to be doing is exchanging your defaulted debt for new debt, which is then serviced by Venezuela and PDVSA.
And you have to remember there, I mean, look, before the bonds defaulted in 2017 in Venezuela, I mean, you had nationalization by Hugo Chavez and his regime of a number of projects on the ground. I'm thinking ConocoPhillips, I'm thinking ExxonMobil. ConocoPhillips has owned $10 billion. Yep. And so that's why its stock popped on the news. But the reality is, good luck trying to get somebody to pay you back for that. That's all part of a restructuring here and the conversations that go hand in hand. And I don't know if you just saw the news, just over the weekend, President Trump had a bunch of U.S. oil majors into the White House to talk about what a, Venezuela restructuring might look like from the perspective of investing, U.S. dollars into the oil sector. He didn't like what ExxonMobil had to say. So, this is a company that is owed $1.5, $1.6 billion because their assets were nationalized previously. the Venezuelan government has already paid back 225 million of that. So they've already almost agreed that they owe this money, right? So good luck trying to negotiate all this out. It's going to be very, very complicated. There's a lot of different investor interests involved. I mean, and like I said, the Chinese and Russian have a lot of bilateral loans in place as well. I mean, where do they fit in the capital stack?
Well, this is what we get to watch.
Yeah, no, it's fascinating. And like this kind of stuff, like, is nowhere in a 60-40 portfolio. I mean, so I like ETFs that bring something different that your normal, like, sort of beta. This definitely checks that box.
Jim, Damian, thanks for taking us on a tour of the world.
Our pleasure.
Thank you.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchunas. Trillions is produced by Magnus Henriksen. Brendan Newman is our executive producer. Sage Bauman is the head of Bloomberg Podcasts.